Okay, this is the daily lesson we want to learn from March the 29th. However, it's the 30th. I know I didn't have time to put it in yesterday, so here it is today. At least you're getting it. Okay, I did not forget to put it in. Let's take a look real quickly at what happened. We shorted the Aussie. We were long on the Euro. We shorted the Pound. We shorted the Kiwi. We were long on the CAD. We were long on the Franc. We were long on the yen. Obviously, we were looking for some strength in the dollar. And we countered with the euro because of where it bounced from and its momentum. But mainly, also, we were encouraged by the fact that we had a gap to the upside. To start out the week, we gapped up. Let's get to the euro. We also gapped up on the pound. We had a notion to take that as well and go along with it, but we didn't because we weren't gapping on the Aussie or the Kiwi. So we gapped on the euro simply because, logically speaking, it was the one that was showing the greatest support areas from last week, as we saw in our videos last week. So therefore we followed the general rule. Also keep in mind the variable to that rule. We were not in any exhausted state to the upside, so gapping up was not going to create a reversal of in any sense. So gapping up was okay to follow that rule. The gap rule is this: a gap tends to fill and then continue in the direction of that gap. So it was a gap to the upside, and it did fill. Okay, the gap opened at 73, came back down to 419. Well, almost filled the gap, but fortunately for us, we came in at the support layer. Oh, excuse me, filling it at 428, and we got that level from over here at 421. We gave some of the spread, but we actually saw, I remember seeing that 28 somewhere. Oh, I don't remember exactly where it was. It must have been in a previous 3-layer area of support, but that's what we did. We went at 428, which is close to the 421, which is why we did it anyway. That's helped relieve some of the pain from shorting everything else and taking the dollars long when we should have been taking them short. We were influenced a little bit by the charts. Let's take a look at those charts. Here's the Aussie. We let me see, this is what we looked at Sunday evening here. If I can get it to stay. Well, just eliminate this big, there we go. That's what we're looking at. We were creating a running line from a bump and run pattern that looked like it was developing into. Okay, without the gap up, we just figured, well, okay, we'll take the short, and the short came in just where these blue lines are up here in this section here, which you can see would have been a logical place of support resistance. However, it busted through simply because if you look at the long-term retracement from this high to this low, or this low to this high, it was retracing at a 382, which is, as you can see now, has pushed up, even though we did look at taking a short at the 92.14 area. Okay, so that's basically the lesson. The lesson is with the gap. This is what we want to focus on, the gap. When you have gaps that are not in an exhausted state, like such as here, the gap to the upside, check that RSI. If the RSI is not exhausted, long that is, so these numbers, if these numbers were something like 94 and 86 or 94 and 96 or 100, and it's gapping up, then you might want to consider looking at some type of signals that are telling you that it's reversing back to the downside, and then you would go with that. Vice versa. If you're gapping down and you've got exhausted numbers, low numbers, single digit numbers, low teens, there's a good possibility that it's going to reverse and push back to the upside. Otherwise, you follow the general gap rule that it will tend to fill and then continue in its direction that it gapped. Okay. Also, the big heartbreaker with the Aussie, that was just a bad trade, because here we're giving the QuickView gave us the signal. It was the fifth Fibonacci day of the trend, of the shorting trend, looking for a reversal there. Also, the fact that we have the day after a squeeze that was to the downside, and the general rule of the squeeze is if it's down, the next day is up, the next day is down, the next day is up. It's a 4-day pattern that we see often when we get this squeeze signal. And sure enough, the pattern took place here, and it's taking place here as well. We're finding resistance at 92.14 on the Aussie at this moment. So anyway, there's your lesson for March the 29th, 2010.